Hello, and welcome to myfinanceteacher.org. In this video, we're going to look at a gold miner called Coeur Mining with the ticker CDE. Before we jump into the analysis, I want to remind you that this is a long-term analysis because we're looking at fundamentals such as the reserves that the company has in the ground, the company's debts, production costs, number of shares, and the value of each of those shares. We also look at a range of gold prices over the next few years to figure out what's our conservative, balanced, and optimistic scenario for this valuation. Now that you realize this is a long-term fundamental view, let's jump into the analysis. First of all, those scenarios for the gold price. Our balanced scenario is going to be just 2% below the ongoing spot price. And the balanced scenario gold price over the next few years is going to be $1,961. Our conservative scenario is going to be 10% lower gold price compared to the balanced scenario. That's $1,765 per ounce. And in the optimistic scenario, we increase gold price by 10% compared to the balanced scenario. That gives us $2,157 per ounce. Moving on to the reserves that Coeur Mining has in the ground. The company has proven, probable, measured, indicated, and inferred resources. In this analysis, we don't actually look at inferred resources, so the optimistic potential is a little bit better than what we present here. I'm trying to lean more on the conservative side of the valuation. And even for the measured and indicated resources, we actually only include half of these into our valuation. So for the proven and probable reserves, the company has 2.4 million ounces of gold and 178.6 million ounces of silver. The proven and probable reserves were last reported in 2019, so I have already actually decreased those reserves numbers by the production so far in the first half of 2020. So that again tilts us a little bit more towards the conservative valuation as opposed to just taking the 2019 numbers. In terms of measured and indicated resources, gold makes up 2.6 million ounces and silver makes up 244 million ounces. The all-in sustaining costs of 1 ounce of gold equivalent, where I use gold-silver ratio of 100, is $957 per ounce of gold equivalent. The reason I have to use gold equivalent is because the company doesn't give a breakdown of detailed costs for the extraction of silver. Next, moving on to the debts and shares outstanding. The company has $287 million in long-term debts. That's according to Yahoo Finance. And the company has 244 million shares outstanding, out of which 1.45% belongs to insider shares. I add this into the valuation as insiders might turn out to be strong hands which supports share price. However, the effect of this variable, the insider shares, is not very significant, so I don't rely too much on the insiders in this valuation. Next, let's remember to discount the value that we have in the ground. Dividing the proven and probable reserves by annual production gives us an average mine life of around 7 years. Since we are taking into account time, we need to take into account the value of time. And in my previous videos, I used to apply a discount rate of 2%. Yesterday, David suggested that I increase that rate a little bit. Let's do it. Let's increase it to 5%. This actually makes our valuation a little bit more cautious, more conservative. And I actually like it. Let's preserve the capital first and then find interesting investment opportunities second. So with all of that in mind, gold price, the amount of reserves in the ground, debts, shares outstanding, and time value of money, looking at the conservative scenario, this is the information we have. Where we apply a gold price of $1,765, say that would be an average over the next few years. We only look at proven and probable reserves of gold and silver, and you've already seen the rest of the numbers, so let's look at the valuation. All of that gives us a valuation of $10.49, whereas the market price is below our conservative valuation. And that's actually with the discount rate of 5 rather than 2%. If we convert this back to our usual 2%, the valuation would be even slightly higher. So in the long term, I quite like CDE. And after a correction, which I expect over the next couple of months, as I've been mentioning in some of my recent videos, so I'll look forward to get back into CDE as that correction comes. Next, looking at the balanced scenario. All the numbers are the same as in the conservative scenario except for the gold price. Our gold price is now $1,961 per ounce. And all of that gives us a valuation of $13.27. And we are still not even looking at measured and indicated resources. We're only looking at proven and probable reserves. We subtract long-term debts from that, take into account the time value of money, and figure out the value per share. So our balanced scenario gives us an estimate which is nearly 50% above market price. I actually quite like that. And next, looking at optimistic scenario. This is where we increase gold price up to $2,157 per ounce, and also we include only half of measured and indicated resources of both gold and silver. So again, we are still being conservative here. The prices over the next few years might actually go beyond our optimistic evaluation. And as we increase the resources we have in the ground, the average mine life increases to 11 years. So all of these numbers give us a valuation of $24.05. So just like gold itself, over the next 2 to 3 years, I think CDE should do really pretty well. So that's our longer term view. Let's have a look at the charts. In the shorter term, as I mentioned, I do expect gold to cool down a little bit over the next couple of months. And that might actually bring CDE prices a little bit lower, even though market price is still below our conservative valuation. The 14-week RSI, this is a weekly chart, has just entered into overbought area. So although in the long term CDE should do pretty well, I don't really want to jump in right now. I'm trying to balance opportunities with risk, and I'm going to jump in when risks versus opportunities are optimized. A quick look at the technicals. The support zone below the current price is somewhere around $6. That is based on the May highs. And the resistance above the ongoing price would be somewhere around $10 based on the mid-2017 highs. And above that, it would be around $12.2 based on early 2017 highs. That is all on CDE. Lastly, if you are watching this at myfinancesteacher.org, I'm glad that you're a member. Let's make money together. If you are watching this on YouTube, this video will be posted on YouTube with a significant delay, maybe 1 or 2 weeks later. Consider joining the membership at myfinancesteacher.org. You can join by clicking this register link on the homepage. Here I post regular updates on a range of assets. I post those updates nearly every day, and my colleague writes these weekly investment newsletters where he shares his extensive investment experience that he's accumulated over a number of decades. For now, I wish you a wonderful day and good luck in your trades.